and welcome to today's presentation. My name is Paul Bishop and I'm a director in our Credit Risk Solutions division based in Singapore, covering the Asia Pacific region. It's a pleasure to be speaking to you today on the topic of factoring environmental, social, governance factors into credit risk analysis. Now, there's no doubt that ESG is obviously a hot topic in the market right now. It's fast becoming a key area of focus and decision-making across the credit space. However, as the ESG space is vast, we'd just like to focus on ESG within credit analysis as it relates to S&P Global. So for us to do this, I've split the presentation today into three sections, covering three of our main offerings in the credit analysis space. So the first is ESG in issuer credit ratings decisions and the research produced around that, produced by our sister company, S&P Global Ratings. And we offer access to this research and to these decisions through our Ratings Direct and Ratings Express products, which are shown here on the far left of our credit spectrum slide. Secondly is ESG enhanced credit assessment scorecards, which we have worked on as part of our credit assessment scorecards business, and through which we really provide an informed judgment-based framework to produce a PD which is based on S&P ratings criteria, shown here on the slide, the second column from the left. Finally, I'll talk about the methodologies which we've developed and deployed within our statistical quantitative credit analytics tools, which are shown here on our credit spectrum slide in the dashed borders. These explicitly seek to account for various climate change scenarios and to capture counterparty credit impacts. Firstly, let us start with the credit ratings and credit analysis. Fixed income investors and credit ratings agencies signed on to the PRI's statement on ESG in credit risk and ratings, of which we can see a small extract of this statement on the slide now. And this basically means that investors and credit rating agencies commit to incorporating ESG in credit ratings and analysis in a systematic and transparent way. However, if we take a step back, ESG is not really new in the credit rating space. If you've ever actually gone through the S&P Global rating criteria underpinning bond ratings and bond issuances themselves, you can actually see that ESG factors have already been traditionally captured in many different ways. However, recently S&P Global Ratings have been producing a lot more documentation to enable market participants to understand and gain more transparency into how ESG factors are specifically incorporated into an issuer-level credit assessment and any impacts that they may have had in a ratings decision. Here we can see just a few examples of the papers that have been recently produced. Obviously, we can start at a very high level and look into areas of the corporate credit rating criteria, financial institutions criteria, specialized lending criteria, just to get a general understanding of how various ESG factors are being incorporated into the existing criteria. But we can go even deeper. There's a wealth of research and documentation that can dive into more granularity. For example, there are papers examining the specifics of ESG factors in specific sectors by sectors. So the difference between, say, regulated utilities and upstream oil and gas companies and what specific areas we would want to look at for those. Furthermore, there's even more research available through the ratings agency that looks at how environmental factors specifically are accounted for in specific rating decisions and case studies where this has had a real-world impact on a company's creditworthiness. So this is a fantastic starting point for any market participant willing, wanting to get an insight into how the rating agency, as experts in the credit assessment space, are beginning to account for these factors and have been accounting for these factors in its existing rating criteria, and how best to approach assessing some of these ESG factors from a creditworthiness perspective. It also helps us at S&P Global Market Intelligence to build on this foundation, to begin to understand ESG and how it will impact on things like credit risk modeling itself, be it on an obligor level or a portfolio level, or through qualitative assessments or quantitative methodologies. And this is especially relevant for us when we begin to extend our understanding of these factors on the unrated space. So for this, let's move on to the second part of the discussion for today, beyond the S&P Global rated universe, and start looking at some of our unrated approaches, specifically the ESG Enhanced Credit Assessment Scorecard. So S&P Global Market Intelligence ESG Enhanced Credit Assessment Scorecards provide a framework to effectively navigate ESG credit assessment, especially in low default portfolio sectors, where by definition, there's a lack of internal default data or external default data that precludes the creation or utilization of statistical approaches that can be robustly calibrated and validated. These credit assessment models at their core combine a blend of risk analysis, quantitative analysis, financial analysis, but also are supplemented by qualitative assessments that are based on expert judgment approaches, such as those developed by the S&P Global Ratings practice. These are there to account for potential default risks of private and public companies across a number of different sectors, and we produce these scorecards on sector-by-sector basis. So our approach is actually to have, within our scorecards products, is to actually have the ESG assessment as part of a holistic approach to assessing credit risk of the entire entity. So in this approach, what we can continue to do is focus on existing and established credit risk assessment methodologies within a traditional credit risk analysis framework, factoring in things like financial risk, business risk, country risk, and so on and so forth, but also provide the analytical flexibility to actually assess a number of ESG factors in terms of their impact on relevant credit risk and credit risk metrics from a bottom-up approach. ESGs are therefore put into context, and through this approach, we can see the materiality of an ESG factor on an obligor's or a project's creditworthiness. It is assessed, it is brought out, and in front of you, you can see a number of different factors that may involve ESG considerations on this slide that we explicitly seek to incorporate into our credit risk assessment and our scorecards. So how do we do this? Well, based on that extensive research and the approaches that have been developed and deployed by the S&P Global Ratings practice to account for these specific ESG factors in various sectors, in various industries, in various asset classes, in their own existing ratings criteria, we have sought to bring those analytical practices into our scorecards and then explicitly highlight these as being ESG pertinent. So our process builds on the practices that are deployed by the rating agency. It produces an output. So the output from the scorecard is a numerical assessment of the obligor's or project's credit quality, which are broadly aligned with the rating criteria. These assessments are produced by the individual user using a robust criteria and a methodology approach that, again, is based on the S&P Global's rating criteria, taking into account best practice for assessment of creditworthiness. But in addition, the ESG Enhanced Scorecard also provides detail and visualization of the impact from any ESG factors on the creditworthiness and ultimately quantifies the contribution of ESG factors to the credit assessment. Adding this has not fundamentally changed our credit risk assessment methodology, but it has sought to bring further transparency to ESG factor influence in the end credit risk assessment. This is the approach that we've employed for our scorecards. Another area that we've been pursuing in terms of expanding our incorporation of climate change and counterparty credit risk in our product line is our statistical credit analytics tools. I'd like to spend a little bit of time today just briefly considering some of the approaches that we've been developing to link climate change to more statistical-based models that we offer. Firstly, when considering climate risk and climate change risk management, the broad consensus among financial risk managers is that risk can be broadly categorized into two main pillars: physical risks and transition risks. Physical risks are first and foremost risks that present due to the direct physical impacts of climate change. So for example, storms, excessive flooding, droughts, wildfires, so on and so forth. These can be acute or chronic in nature and are probably some of the most immediate risk events that one imagines when thinking of climate change. Secondly, we can also consider, and one that's particular interest from a risk management perspective, is transition risk. So transition risk arises as the global economy moves towards a low carbon paradigm. It results through policy decisions and it manifests in legal, technological, market, and reputational risk dimensions. So both of these risk areas are of great importance for us as risk managers as we seek to mitigate the impact of physical risks on our business, but also accommodate for the risks and opportunities arising from the transition to a low carbon economy. Now, one of the primary mechanisms that's been adopted by governments internationally to facilitate the transition to a low carbon economy is carbon pricing. Global regulators of financial services companies in particular are beginning to lay down frameworks to specifically incorporate climate change risks in their stress testing exercises and frameworks for banks going forward. So most notably, one of the first movers in this space was the Bank of England Prudential Regulation Authority, which was looking at this as early as 2019. Other regulators have continued to follow suit. We've seen a number of regulators within Asia Pacific who are evaluating this. We've seen some very broad statements from some of the larger economies, most notably China, looking to be carbon neutral and ensuring that they transition, obviously all of their economy and their financial services will need to follow suit to a much more low carbon paradigm. So this is going to become, and we've seen it this year, this is going to become a very real consideration for us as risk managers to account for whether we work in financial services or whether we work in supply chain risk management. This is obviously a transition that is going to be coming over the next few years. So as we mentioned, it's prudent for us as risk management professionals to start to consider the practical challenges that we might face when we attempt to actually understand the real world impact of climate change on our counterparty relationships, not just through physical events, but also through this longer term transition mechanism. Specifically, when we started to look at this at S&P Global, we were considering questions around how would we seek to incorporate this into scenario analysis and stress testing that is routinely employed in banks, but also could be employed in corporate treasuries, investment management teams, professional service providers. What are the kind of questions that we're going to need to ask? First and foremost, if we wish to consider the impact of carbon pricing on companies, what data exists for us to understand company level emissions? How are those emissions distributed geographically, given that carbon pricing is employed often at the state legislative level? We may have an international company that has operations in a different country that may be exposed to a different carbon pricing regime. How do we understand what our portfolio of companies are emitting and where they are emitting them? When we look at scenarios for carbon pricing transitions, what types of scenarios should we be considering for different countries or for different industries? What's the time frame we should be looking at? How many scenarios should we seriously consider? Again, a big important side of things is how do we connect these transition risks to creditworthiness and actual credit quality changes? So how do we encapsulate both the upside and the downside? There will be winners and losers to some of these opportunities and some of these risks. As we began to investigate some of the approaches to solve for these types of questions, we came up with a couple of different frameworks. And I'd like to share some of these frameworks and some of our discoveries with you now. So first, we're able to separate our approaches to these types of climate change counterparty risk assessments into really two broad categories. So fundamentals or bottom-up approaches and market-driven or top-down approaches. Now, both approaches have their own merits and limitations. So we believe it is very much worth understanding the nuances of each of these approaches and deciding which will be broadly most applicable for your requirements, maybe both, maybe one. It's important to understand some of the specifics. Firstly, our fundamentals approach. We developed this in consultation with Oliver Wyman, which is a leading consultancy in the field of climate change and its global financial impacts. It's focused in its early stages purely on upstream oil and gas firms globally. It produced basically a firm's full projected financial statements, and then we use those full financial statements to run through our internal statistical credit models to give adjusted credit scores over a specified time horizon based on the methodology that we developed in conjunction with Oliver Wyman. So secondly, our further approach, which came after the fundamentals approach, when we realized some of the limitations that we'll kind of go through with the fundamentals approach, is we sought to develop a market-driven approach, which actually expands the coverage. So it covers all publicly listed firms globally across all sectors in a much broader methodology. And it produces a firm's projected market capitalization and its adjusted market signal default probability. Now, both approaches, as we mentioned many times, have their own merits and limitations. So we'll go through a little bit more details now so you can get an understanding of what they are. So firstly, let's work through our fundamentals-driven approach. The fundamentals-driven approach utilizes two main climate change scenarios. So the first one is a pure downside scenario based on increasing user-defined carbon pricing scenarios. And the second is an integrated macroeconomic model called the Remind Energy Economy Model, which spans the years 2005 to 2100 and accounts for much more of the nuances in regional investments and developments as part of its overall macroeconomic framework. So rather than just looking at specific changes in carbon pricing in a region as a whole, we would see carbon pricing potentially move slightly differently based on regional nuances in terms of various macroeconomic drivers. Oliver Wyman and ourselves, we then identified 4 key drivers that would actually primarily be the drivers that would impact, drive the impact of a given scenario on, as we mentioned, an oil and gas upstream firm's financial statements. So the ones that we determined to be the most valuable here were volume, unit cost, price, and CapEx. Now, based on the analysis and economic forecasting done by Oliver Wyman for a given climate scenario, these drivers and their adjustments were then applied to S&P Global Capital IQ baseline financials to produce adjusted income statements, balance sheets, cash flow statements based on a specific time horizon and climate change scenarios. So whether it's the Remind model, whether it's specific carbon pricing, but it would produce these adjusted financial statements, which were, and then in turn, we could take and run through our own statistical credit scoring model or credit model to produce projected credit scores based on the user-defined climate change scenario. Or take those financials, for example, and run them through a third-party model. If you were working in a bank, you can also just take those financials and run them through your own internal models. And you can get a sense whether a company that would be considered, say, AA plus today would potentially become, say, a single A minus in 2024, for example, according to the parameters specified, or maybe if it's resilient enough in its fundamentals and operational profile to remain, say, a AA plus under the specified user approach. Now, this approach, I would say, represents the most robust and bespoke approach, but the limitation primarily in its application is that the key drivers that we defined are very industry specific. So for different industries, you would need to go back and select new drivers, look at new supply demand curves, so on and so forth, and really redo a lot of the economic forecasting and analysis on an industry by industry basis, which we are currently seeking to do. So we are actually looking to expand this offering to key climate change linked industries such as wider oil and gas, metals and mining, power, shipping, transportation, and agriculture. But obviously the limitation here is that it is quite a granular approach that is very industry specific. So next, our natural progression from this was to look at an approach that would try and cover more, try and look to get broader coverage, which is how we came up with our market-based approach, which really, I think, complements the fundamentals approaches, but as we mentioned, provides broader coverage than industry-specific fundamentals approaches, which are in development. We can start using this to, in a kind of common sense approach, try and get a broader portfolio level coverage of all sectors based on market-derived signals, right? So we're looking at market data here, which is broadly available, but the limitation there is that obviously we can only use this for publicly traded companies. So we've looked, again, as we've discussed, that carbon pricing is the main major mechanism that's being adopted by governments to facilitate the transition to a low carbon economy and to limit global warming to a specific level. So understanding, therefore, how those carbon prices are expected to move alongside the insight into company level emissions. So how much company A, company B, company C are emitting and where they're emitting. That's a very powerful data set to identify the winners and losers of carbon price movements. You know, if you're emitting less, more, where you're emitting it, what price you're exposed to. So we have a team internally in a database that's maintained called TrueCost, that maintains a very, very large database across a number of different industry sectors, across a number of different major economies, across a number of industries, looking at things like company level emissions, scope 1, 2, 3 emissions, but also scenarios, transition scenarios from 2020 onto 2050 for different carbon pricing paths. And these transition scenarios cover 44 major economies, and the transition scenarios themselves cover all industry sectors. Basically, these range between slow, moderate, and fast carbon price increase paths based on existing policy frameworks and defined global warming targets such as 2 degrees Celsius and so on. So you can kind of get a sense on the slide here what these three kind of fundamental scenarios look like. Now, utilizing the coverage and the database that the TrueCast data at a company level provides, so we have around 33,000 plus companies available with scope 1, 2, 3 emissions, so whether it's kind of emissions basically produced in the production of goods or services, whether it's ancillary emissions, such as, cost of powering offices, for example, whether it's scope 3 emissions, cost of suppliers, entities in your supply chain, in addition to the emissions that are actually produced as part of the production process. We have a variety of different data sets here that really seek to capture these kind of company level emissions globally. And utilizing those data points and these transition paths that we've predetermined, the slow, medium, fast, we began to consider a methodology which would produce an adjusted company market capitalization and then determine via a Merton structural model approach. So a lot of you will be familiar with Merton structural models, I'm sure. Produce a company's new distance to default under a specified user scenario. And therefore, what we can do using our PD model market signals, which is an internal statistical model, which at its core is based on a Merton structural model approach, but actually takes that distance to default and maps it back to an associated 1-year PD, associated term structure PD, associated implied credit score. We can give you, again, an adjusted credit score, an adjusted credit metric based on those scenarios. So if we go through this flow, firstly, what we do is we select our climate-linked carbon pricing scenario. So whether that's slow, moderate, or fast, we use the carbon pricing determined by the research team at TrueCast to calculate for companies the additional carbon tax that's going to be applied to the company based on the adjusted carbon price and the company level emissions. We look specifically at scope 1 and 2 emissions and any forecasted CO2 reductions specified by the company and captured in that data set. So if a company's committed to reducing carbon emissions by X% over a certain time frame, those will be captured as well. This basically leads to a mechanism which incorporates and accounts for an operating expense change. So straight off the bat, we can see additional carbon tax, any change in operating expenses that happen for that company based on that scenario over a given time horizon. And then we really wanted to capture a transition mechanism that would capture some of the opportunities offered by the change to a low carbon economy. The companies with a larger market share or companies with more firepower for investments and historical capex might be well placed to capture. So these adjustments then lead to a further adjusted operating expense change. And then we also look at an adjusted market share change where any appropriate opportunities are factored in, which leads to an adjusted revenue change. And now we have, when we combine the operating expense change and the revenues change, we look at a new EBITDA. So what we've done there is the market share change really captured by understanding, companies with larger market share, more firepower, historical capex, might capture more of the market over their transition. Companies that emit more, companies that have emissions in higher carbon pricing regions are going to have further adjusted expenses, which leads to an EBITDA change. Given the new EBITDA, given the new operating expenses, and assuming that the valuation multiples for that company remain constant, we can then back out a new company market capitalization. Now, once we've got the new company market capitalization, we can use that change over each time period to calculate a new distance to default under that Merton structural approach, which we produce under our PD model market signals, which, as we can see, gives us now our developing credit score changes for our specific scenarios. So as you can see, this approach, I think, sacrifices some of the specific industry and company level drivers that our fundamentals approach for the oil and gas upstream sector really captures. But it is broadly applicable for all industries, provided that that company level emissions data is available. So really just an approach looking to complement, I think, the fundamentals approach, and just sharing with you some of the, I think, developments and understanding that we gained, trying to capture all of the workflows that we could see coming down the pipe for obviously needing to understand some of these credit adjustments that would need to happen with regards to climate change. So just to sum up there, I hope that you can see, from our pretty broad research into ESG and climate change specifically, that there are multiple drivers pushing all industries to consider ESG and climate change specifically. Obviously, a big factor going forward in ongoing operations. This is obviously bound to create a lot of challenges for risk management professionals going forward. Having access to, the methodologies, the robust methodologies that are being developed by some of the rating agencies, having access to that underlying expertise, the tools, the analytical methodologies and the credit analysis models that we have access to. We've been able to really start to flesh out some of the ideas as to how to best approach this. And really, I hope that just by sharing some of our insight into our own work in the ESG and climate change and credit risk space, it's provided you with some food for thought about how to start to tackle some of these operational challenges. We continue to seek feedback from the market into our existing and developing approaches and our tools. So with that, and to make sure we leave enough time for questions, I'd like to thank you for your time. And I'd be happy to hear any thoughts or answer any questions you may have on the presentation now. Thank you very much.
Hi there, I hope you found the presentation informative. We've had a few audience questions that have come in, so we'll take a few moments now just to go through some of those questions, give you a bit of a response. Just a reminder that you can submit any questions either via email or through the chat box. Happy to answer any that come in. The first question that we had through the presentation was, how do you backtest and validate climate-related credit risk models, which is an excellent question. Because essentially we're trying to model for something that has not historically happened. So this obviously presents something of a challenge when we're somewhat used to taking out sample results and going back and testing for them. So what we've tried to do really here is, throughout all of the approaches that we've developed, is rely and relate them back to the established methodologies that we have, either through our statistical models or through the criteria set by S&P Global Ratings, which obviously has been tried and tested and develops throughout time. So a lot of these adjustments that we make are really inputs into models that are tested for default recognition on a corporate level. What we're really focused on mainly is ensuring that the framework that we have that provides the inputs for these models makes robust, rational sense. Which is, as you kind of went through on the presentation, why we engage kind of sector-specific specialists like Oliver Wyman, and they have a team of economists and so on and so forth, and climate change specialists that really work to provide us with a logical working framework for a given sector. Similarly, with the market signal approach, what we're looking to do is produce a rational framework that gives you some form of mechanism into how you would adjust a company's financials to produce a new market capitalization. But the model methodology itself, in terms of the actual mechanism that creates the credit change, is still based on a Merton structural model approach. The model that we use for the Oliver Wyman financials is still our credit model, which is back tested again on a yearly basis on out of sampled ratings data that was not included in the training sample. So really we're focusing on leveraging the existing experience that we have in the space, but also making sure that when we layer a framework on top, that it makes robust economic sense. We have another question that's come in with many different stress scenarios that can be used, how can we hone in on the most important scenarios for credit risk analysis? This is an excellent question. There are many scenarios to be used, and I think we're still at the stage where, as we mentioned, regulators like the Bank of England, regional regulators in Asia Pacific, are looking at what these kind of scenarios are going to be kind of set, right? So what we've tried to incorporate in our tools and in our frameworks and in our offerings is the ability for you to flex really the scenarios that you look at. So we mentioned the Remind, which is a regional model of integrated development approach, which is a much more integrated, regionally nuanced macroeconomic model that looks at climate change scenarios. Or you can just have a pure carbon tax scenario, which simply looks at, if the cost of carbon increases by on a fairly linear progressive scale, what's that going to do to a company's financials? So those are a few of the scenarios you can look at. Obviously, it makes sense to look at what we're trending towards and what we're trying to do in terms of global climate change regulation. When we look at things like 2°C management, when we look at things like the Paris Accords, those have very real-world implications in terms of how much carbon can be emitted into the atmosphere in order to meet those requirements. And those are fairly regularly mapped out and modeled by climate change scientists and also economists. So it makes sense for you to align with probably the best case scenario or the scenario that you think makes the most sense. We're really not seeking to prescribe those scenarios. We're seeking to enable you to compare a multiple set of scenarios together. We've had quite a few questions actually come in. We may have a few that we have to get back to. Are ESG and climate factors always a negative impact on creditworthiness? So I know we're running short on time, but the short answer is not necessarily. If you were to take the example of Tesla and Ford, would be a fantastic example. Both are companies in the same industry, potentially serving the same geography, but obviously one is much more well positioned to withstand some of the changes that are going to happen through climate change and this transfer and transmittance into a low carbon economy. And obviously, therefore, it's better suited to capture that changing market dynamic. So we would expect that some of those ESG factors actually would potentially have a positive impact on its creditworthiness. Obviously, they are not necessarily to be viewed totally independently of the financial reality of the company, but you could potentially see there being examples where companies might have positive ESG factors. If we were to look at good governance over bad governance, we are not necessarily saying, obviously, that if there's any kind of governance factor coming in, potentially it would be a negative one. Companies can have positive credit improvement through the fact that they have established continual governance, as we would probably all make rational sense of. It would obviously be a credit positive there versus a company that just has maybe a 1-year track record that might not have any kind of credit uptick, or even a company that has potentially a demonstrable track record of fraud or potentially misleading investors. So it can go both ways, and I think whichever approach is being used to recognize that needs to obviously account for both, which is what we've tried to do. I'm conscious of the fact that we're somewhat out of time now, and I know that there's a very good session coming up with a good colleague of mine, Eric Nietzsche, who's going to walk you through some panel discussions. We have got a few more questions, so we'll hopefully get back to those individuals that pose those questions, but I hope you found the presentation informative. If you have any further follow-up at all, please do reach out to any of the colleagues at Asia Risk Congress or myself personally. But thank you very much for your time, and I hope you have a fantastic day. Thank you.